Hello, everybody.
Got it.
Welcome. Welcome, everybody. Greetings to all of our alumni joining us. My name is Greg Leparati. I'm Associate Director of Alumni Relations here at Baruch College. Pleasure to have you all here with us. I am Zooming from Astoria, Queens. Feel free to put in the chat bar where you're Zooming from. We've had alumni joining us from all over the world, so it's been super interesting to see where people are tuning in from. I would request that everyone please mute their microphones. You can keep your video on if you'd like. We love to see people's smiling faces. But we would appreciate it if you could mute your microphone, just so there's no ambient noise or anything. Let's see here. Okay, yes. Welcome. As I stated, my name is Greg Leparati. I'm super excited to be having today's event. We were joined by Chen, also a Baruch alum, who's going to be presenting this evening. Alan led 3 financial literacy workshops with us in the summer, which were super successful and interesting. Now we're sort of expanding the financial literacy workshops into this semester, and we're starting today talking about novice stock market investing, which should be super interesting. I know I have very little knowledge and experience about it, so I'm very interested to see what Alan has to say. A little bit about some ground rules this evening. First off, we will share a recording of this afterwards, so if you miss anything, don't worry about it, because we will send out the recording. Also, as I mentioned, please mute your microphones. And if you have any questions throughout this presentation, please put it in the chat bar. Alan will try to get to as many as he can during the presentation, but if for some reason he can't get to your question, there will be time at the end, so we can get to all the remaining questions that you might have. A little bit about Alan. Alan is a software engineer by day, and by night, he's deeply interested in financial literacy. So he is not professionally a financial planner, which is actually what makes this super interesting. There's no agenda here from Alan. He's just super interested in these topics and wants to share his knowledge with us. He graduated from Baruch and realized that despite having a business degree, he did not know how to manage his own finances. So he began really studying various aspects of financial literacy, and his goal is for everyone to retire happily. So today he's going to be talking about stock market investing, and I'll talk a little later about some other upcoming webinars we have with Alan as well. But for now, I present to you Alan Chen.
Thanks, Greg. I really appreciate it. So welcome to the Financial Literacy Workshop. I usually have these workshops on a month-to-month basis with students, and I recently expanded to alumni. Happy to see all of you here. It's a lot of people actually for this workshop. And I do run a blog on the side to moonfund.com where I just write about personal finance and retirement and my experience and my approaches to saving for those financial goals. And so stock market investing is a scary journey, right, for many of us, because you could potentially lose a lot of money, or you could potentially make a lot of money. And during this session, you're gonna go from having zero knowledge of investing to pretty much just the minimum you need to get started, right, to start your long journey of accumulating wealth. And there are several key topics we're gonna go over: investing, impact on taxes, and researching tools. One thing to keep in mind is we're not gonna touch every topic in depth. What I'm going to have is links throughout this presentation where you can learn more, right? And the whole approach is to help you find out where to look and how to do your own research is really the goal of this. I mean, keep in mind, this is a novice webinar. I did have someone reach out previously about specific topics that were much more complicated, like related to spreads, bids, puts, options, or multiples of anything like that. I'm not going to be going over any of that because that's more on intermediate level for people who have an understanding of the stock market and have an understanding of all these technical analysis that's involved with it. I don't have that experience per se. I'm mainly a passive investor, so that's my view on it, but I will dive onto the high level topics so that whatever path you choose, you can pick. For those of you who've taken Finance 3000, or remember anything from Finance 3000, most of this might not be anything new, depending on who your professor was. I know that class was very liberal in terms of what you can learn and what you don't learn, right? So a little more information about myself. As Greg mentioned, I am a CUNY Baruch alum, 2017, so not that far off from some of you in the chat that mentioned it. I do I was born and raised in Brooklyn, and growing up in a low-income immigrant community, I never really learned about money. It was not a topic that was talked about, just because there wasn't a lot of money going around, and you didn't want to bring it up because the conversation never leads to anywhere that was fun, essentially, right, or anything worth having. And it was, I firmly believe that everyone should have an opportunity to learn about money, right? An opportunity to learn about how to retire and how to really engage in these conversations. And for some immigrant families, depending on where you're from, a stock market is no different from gambling for them, right? When I told my parents I was investing in the stock market, they told me, "Are you gambling?" Because that's what they thought it was, right? But and in my opinion, it depends on your approach to the stock market, right? You can make it gambling, right? If you just blindly go in and you just say, "Hey, today I ate a McDonald's sandwich. I'm going to buy some McDonald's stock." If that's your approach to it, maybe it's not the best move, right? You should have some form of plan, right? Some sort of analysis going into it. And if you're going with the idea of making a quick buck, it may not be the best idea depending on how you're going about it, right? If you're a day trader, that could be a little bit different depending on where your expertise lies. And there's no guarantee to the stock market, right? Just keep that in mind. There's no guarantee to it, but you can have a strategy around it at the very least. Now, a quick disclaimer, right? I am not a financial advisor. Investing is not my day job, right? It's just something that I do part of my time, something that I learn on the side. And if you are having issues with investing, with taxes, anything of that sort, you should seek a licensed professional for financial advice because they will help you much better than anything that I can do. And as a reminder, feel free to ask questions throughout the workshop. Use the chat. I am monitoring it, so anything comes up, I will be watching it. So when it comes to investing, I like to keep it simple. In my opinion, yes, it is a very cute dog. I appreciate that. It's not my dog, but it is a cute dog. Anyway, for investing, I like to keep it, I like to follow the idea of KISS, right? Keep it stupid simple because it can be very complicated if you decide to make it complicated, but it doesn't have to be, right? And you can have a strategy, you can have a simple strategy around investing. But here are some of just the terms, right, that you might come across. Obviously, this list is not finite. There's going to be a whole bunch of terms outside this list, but this is just to get you started, right? So the first concept I want to go over is, low risk equals low returns, right? If you choose an investment that's a low risk investment, so it's not very volatile, then you're gonna have low returns. High risk, on the other hand, is high returns. If someone comes to you saying, "Hey, I have this low risk, high return investment," it's either a scam, which is probably the case, or it's going to be an amazing investment opportunity, right? But chances are it's a scam, so you should, do your own due diligence and keep an eye out for that. And the next thing I want to touch upon is a stock, right? A stock is basically a piece of a company, right? When you purchase a stock, you own a piece of that company, and that company does well. Ideally, what it means, or usually what it means, is that you make money as a shareholder, right? You have specific rights regarding stocks, and you could read more about that in the link I provided. Usually, it'll lead to some site where you can learn more about it. In this case, it's going to be Investopedia. For those of you who aren't aware, it's a great tool for learning about investments. Next up, we have mutual funds, right? A very popular term. Depending on, yes, so slides will be shared. So you will have access to all these links. Next topic here is mutual funds, right? Mutual funds is very similar to stocks in the sense that it's not that similar, but basically it's an investment tool, right? You pool all of your money to buy multiple stocks or really any other investments, and usually it's managed by a professional investor. What's the website for investments to check out? It depends, right? It depends on what you're looking for. You can easily do a Google search for the type of stock you're interested in. You could say something like, "Hey, I'm interested in the high growth stocks for this year," or you're interested in a certain specific sector of those stocks. But you can check out various sources regarding people just doing free financial analysis for these stocks, and they'll do stuff like they'll check out financial reports, industry reports to give you an idea about what investments they're thinking of. Obviously, do your own research, right, when it comes down to it. But yes, Investopedia is a good place to learn terminology. I will have a link here as well as additional resources, and these specific links does go to the specific terminology. And next thing we want to talk about is diversification, right? Every time you hear about investments, the first word you'll hear, the second word you'll hear coming out of people's mouths is to diversify, right? It's very simple in terms of, don't put all your eggs in one basket. We're going to talk more about what that looks like in a bit. But just to give you a quick example, let's say you think Microsoft is a great company, right? It's going to do well, you think, for hundreds of years, right? So you buy one stock of it, you put all your money into Microsoft, right? And not the best idea, because what if Microsoft goes bankrupt tomorrow, right? Can it happen? Yes. Is it likely to happen? Not very likely, but it can happen, right? So you want to avoid any instance where your money's all in one place and something happens and you lose all of it, right? So the purpose of diversification is to reduce your losses during a market downturn, so recession like what recently occurred, and to maintain growth when the market is strong. But we're going to dive more into that in a little bit. All right, so more additional concepts that you'll hear on a day-to-day basis if you're really into investing. One of the big things is the indexes you hear about. So this is the S&P 500, the Dow Jones, the NASDAQ Composite. And all of these are basically the most followed indexes to indicate the health of the stock market, right? If you're following today, you'll know that the stock market didn't do so hot, right? We dropped a lot today, which is not great, but these are indexes that investors use to measure and gauge the health of the stock market overall, right? There are obviously pros and cons to using these indexes, and you can read more about them in these links, but they all follow something specific, and generally it's a well-accepted form of measurement. Now, the second thing here is cost basis. Now, this is very important because it does impact your investments in terms of taxes, right? But the basic definition of cost basis is how much you paid for your investment, right? So this is the original value of the asset plus any commission fees. So let's say if you bought a stock for $100, the cost basis of your purchase is going to be $100. Right? And that number is very important because it does come into play when you have to calculate your taxes. And the ways you can calculate your cost basis will vary, right? So when you come across this point where you have to think about taxes and the cost basis, especially when you sell your investments, you want to reach out to an accountant just because they'll have a better idea about it, especially if you're not confident in your record-keeping abilities and your mathematical abilities. Right? This is one of those things where it's better to offshore it than do it yourself, unless you're really good at keeping track of all of your investments over a period of time. Now, gains and losses, that's a pretty straightforward term, right? If you made a gain, you made some money, right? So if you purchased a stock for $100 and the next day it's worth $101, you've made a gain of $1. If you a loss, same idea, right? If you lost money, that's considered a loss when it comes to your investments. Now, the concept of unrealized and realized are a little more nuanced in the sense that unrealized is all the stocks you haven't sold yet, right? And realized is anything you have sold, right? Which will trigger a tax event, whether it's a gain or a loss. So there's realized gains and there's realized loss. Yes, there's a lot of concepts, so I'm happy that we're recording it as well. And one big topic here is growth versus value investing. I promise this is the last of the terms. Then we'll dive into more details about specific things. But growth versus value investing is important because it does come up a lot, especially for people who are just starting out investing. Basically, it's two approaches to picking stocks, two very popular approaches that do come up. And the basic definition is how you go about picking your stocks, right? Your methodology and your strategy when it comes to that. Growth stocks are basically companies that have higher growth rates and that had high growth rates for the past few years, and they will for the foreseeable future, is what people predict. right? So value stocks, on the other hand, are stocks that are believed to be undervalued, right? Something may have occurred in the immediate future, but their financials are good. The company's board is good. Their execs are good, and they have a really good plan going forward for the industry. But for the time being, their stock is lower in value for whatever reason, right? Some immediate event, short-term event occurred, right? That's what we consider value investing. You're looking for stocks that fit that category. And now there are pros and cons to both, and I definitely encourage you to do research on them before selecting an approach, but most people generally have a mixture of these two approaches, right? And as I mentioned, there's many more terms. I've touched upon a few, if any at all, but should be enough to get you started in terms of researching and digging into them. But if you want to learn more, the links are provided. Now, the next thing I want to talk about, as I mentioned before, I said that I was a passive investor, right? What exactly does that mean, like a passive investor? Generally, investors fall into two categories on sort of a spectrum, right? On one side, you have passive, on the other side, you have active. And most investors fall somewhere in between. Rarely do you see people all the way at the end, right? Essentially, if you're an active investor, right, you're someone who is constantly tracking the stock market, right? You're spending a lot of time in the stock market. You're spending a lot of time looking at your investments. You have really complicated strategies and really complicated financial tools that you're using to determine should you buy this investment or should you sell this investment and when, right? And because you're so active in it, you're triggering a lot of tax events, right? So sometimes your taxes can be really, really complicated, but it really depends on your investment philosophy and what your strategy is going forward. And really a typical investment for active investors is anything goes, right? You could be trading currency, you could be trading commodities, you could be trading stocks. Really it's anything goes here. And people, when you think about an active investor, you're thinking of someone that's a day trader, right? Someone who's trading every day when the market's open to the time it closes, and planning their next moves overnight. That's what usually an active investor means. And the generic goal is to beat the S&P 500, right? Getting higher returns than S&P 500. Like we mentioned before, the S&P 500 is an index that determines how well the stock market is doing, right? The goal of an active investor is to make more money than the standard average for how well the stock market is doing. Otherwise, why not just follow the stock market and invest in that index? So their goal is to make more money. On the other hand, on the far corner, you have passive investors, which is what I am, right? So it's less time, it's less complexity, and it's less complicated in the sense that I basically purchase a mutual fund or an ETF that's tracking the S&P 500. So if the stock market does well, I do well. If the stock market doesn't do well, then I don't do well, right? Nothing too complicated there. I'm offshoring most of my investment know-how and all of the complexities involved with should I buy, should I sell, to investors, right? They'll handle it for me. And I'm tracking index, so there's nothing to think about essentially from that point of view. And the generic goal there is to make the same amount as what the stock market will perform on average, right? So the S&P 500. And things to call out here is that there's no better investor, right? People tend to talk about, hey, active investing is better because I'm making more money, or passive investing is better because I'm not trying to beat the market because that's proven to not work, right? These statements are very extreme, right? It's not necessarily true across the board. But one thing we can say is active investors tend to perform better during a market downturn, so recession, because they're obviously they're actively looking at the market and they're adjusting their investment goals based on environmental factors. If you're a passive investor, you basically don't care. If it goes down, it goes down. If it goes up, it goes up. You're just riding the wave. So that's one key difference there. Depending on which one you are, likely you'll be a mixture of both, right? Just to either reduce risk or to get a better idea about approaches that will make you the most money in the end, right? You don't want to be one extreme. You don't want to be too extreme toward one side. All right, now Another thing we want to talk about is investment analysis, right? These are the types of analysis that you can do when it comes to looking at a specific stock, right? And if you took Finance 3000 to any degree and you remember what that class taught you, they might have gone over these concepts on very high level, but you can dig more into it here. But really, it's fundamental versus technical analysis. Again, very hotly debated topic in terms of like which one's better, or which one's makes more money, and the answer is hard to say. Right, pick the one that works for you, that you believe works for the stock, and that you prefer. Right, no matter where you look, it's going to be one of those topics where, hey, this research said fundamentals better, or this research said technical is better. But just to boil it down, fundamental analysis is looking at economic factors, state of the industry, and the companies themselves to determine if the stock is over or undervalued, right? So you're looking at financials that the company releases, you're looking at any public statements, news articles, just doing research in that regard. On the other hand, you have technical analysis, which is focusing strictly on statistical trends of trading activity and determining patterns in the stock's historical price and volume data, right? So basically, you're looking at all the price data and saying, hey, do we think it's going to go up? A good example of this is if you think of a company like Macy's, right? Obviously, before the pandemic, if you think of a company like Macy's, generally you'll see that these type of companies, these department store companies, tend to tick upwards in stock price when they get toward the end of the year, just because that's when they make most of their sales. That's when Christmas is. That's when Black Friday is. That's when all these holidays are. So you'll see patterns there, or maybe there'll be patterns for holidays, seasons. So things, those are the things you're looking out for when you do some technical analysis. All right. Now, one other thing that I want to dig into is dividends. Now, dividends, I'm sure you heard the term being thrown around, but in terms of like what it actually means, we're going to dive in a little bit into that. So dividends are basically paid to shareholders on a reoccurring basis for being, basically holding their stock, right? They're basically paying you for holding stock because you're a shareholder. And companies will pay it out if they're financially able to. And when I say if they're financially able to, it doesn't mean the minimum bar is that they're making money, right? Because if they're not making money, they can't pay out dividends to you. But if they are making money, they're not required to pay you dividends, with a few exceptions, right? Some type of companies are required to pay out a percentage of their revenue or earnings as dividends, and those will vary based on laws related to that. But most of the time, companies are not required to pay you dividends just because they're making money, right? Because you can make the argument that if they reinvest their profits into the company, they can give you a higher share price because then it will go up, right? Or you can make the argument you want your dividends now, so you'll get money paid out to you either on a quarterly or yearly basis, right? So dividends are not guaranteed, and it really comes down to the specific company that you're looking at. But you can look up if a company is offering dividends or not. Usually it's the data is referred to as a dividend yield. It's something that you can find. But it's also important to note that dividend is income when it's paid out to you during these periods of time. So it is taxed. So almost by default, if you start investing and your stocks pay you dividends, you will have a larger set of information when it comes to filing for your taxes, right? Something to be aware of once you start investing. But you're not going to be in the dark, right? So your brokerage will send out an IRS form, 1099 div. And you can read more about it here. I've linked the IRS form there so you can see more information about it and what it looks like. But essentially, if you're using something like TurboTax, right, or some kind of online filing service, or even an accountant, right, if you just input the numbers as they appear in the boxes, like it's almost like a W-2, right? If you are working, it will be simple to straightforward to fill out, and how they're taxed will vary depending on the stock. So that's a little bit different, but you will get taxed nevertheless. And, I've linked here. Someone asked, hey, where can I find information about kind of stocks are out there? Well, it's a quick Google search away, but in this case, I just did some searching for you. So there are 25 high dividend stocks here from the NerdWallet. Obviously, these will change from time to time because companies can elect a different dividend yield depending on what their board decides to do. So this is one way you can look at stocks in terms of if you really want to focus on dividends. There are investors out there who've entirely focused on getting stocks that pay high dividends consistently so they can have some sort of revenue. Think of it like if you purchased a home and you're getting rent, right? Similar idea there. It's like recurring revenue based on your investment. Now, before you think about, I've gave you a bunch of terms, I gave you a bunch of approaches, I gave you a bunch of information, right? But I haven't told you how can you get started. Right? And I think the first step when it comes to investing for stocks, the first step to getting started is to find a brokerage. Right? This is the first thing you can do. And there are many brokerages out there. I'm going to list a few in a bit. But most brokerages offer tools besides buying and selling stocks, right? They offer financial advisors. So if you're interested in that, they offer their own financial tools. But here's a list of all the brokerages that I've seen, have experience with, or my friends have used. Obviously, this is not a finite list. There's so many more out there, but this is where you can get started, right? There's Vanguard, Charles Schwab, Fidelity, and the millennials' favorite, Robinhood, right? That's still hanging around. So there's a lot out there, and I would encourage you to do research into which one's best for you. But generally speaking, most of them are very similar now. Robinhood used to be the only one that offered, not the only one, but it used to be one of the few that offered zero commission fees when it comes to trading your investments. A lot of companies have followed, and they've also implemented similar policies now. So most of them don't have commission fees when it comes to trading, but you should do your own research. That can change at any time. Before opening an account at any of these institutions, you should check if there are any hidden fees, right? Like any company, they need to make money, and making money can come in the form of hidden fees sometimes. And it really will vary from company to company. I'm not going to say one company is better than another company because there are obviously trade-offs, whichever one you choose. But one quick way to Google if there are fees, you can just do something simple like, hey, Vanguard fees, right? And see what comes up on Google. It'll be the first or second link when it comes up. Someone mentioned a really good point here, minimum investment to open accounts. That's a big one. Some of them have minimums and some of them don't, right? So it also depends on if you already did research for what kind of investments you want. Some of those investments might have minimums, right? Like a mutual fund might have a minimum. Right? So you should definitely do research into which firm might offer mutual funds that don't have minimums. Right? So there's a lot to digest, but just do due diligence and figure out if there's fees involved. Someone asked, when opening an account, which should I choose? A brokerage account, a Roth IRA, traditional IRA, or rollover IRA? Yes, those are a lot of different types of accounts, and it will vary on your financial situation. But since I'm talking about just stock market investing, if you're not thinking about retirement, so Roth IRA and traditional IRA and rollover IRAs are for retirement, right? So to open those accounts, you have to fit a specific set of requirements detailed by the IRS. So you can look those up if you just type in something like IRS Roth IRA. But otherwise, I would say go with a brokerage account. There's not going to be any restrictions regarding that for the most part. And yeah, I mean, advisors will be able to tell you the difference between all four of those. But if you're not opening it for retirement, I can say for sure, hey, go with a brokerage account because IRAs are for retirement. Besides looking for hidden fees and investment minimums, are there any other factors we should consider when choosing a brokerage? One thing I like to consider that I'm not sure if anyone else really cares about is actually if they have a mobile app and how well designed their mobile app is. Because I know that Fidelity and Vanguard have a mobile app, but it's terrible. But Charles Schwab has a great mobile app. So I'm not sure how often you're going to be checking your investment. I mean, Robinhood has a great mobile app as well. So I heard Webull is good too. So I know a few of these other alternatives like Webull are offering free stocks, I think, like one free stock if you join. I'm not going to put a link here because that's going to be a conflict of interest on my part. But you can check out Webull. I think they're offering something like that. But Webull is a great choice. I've heard people say great things about it. But stuff like that, I'm considering about the experience. How often are you a trader? If you're a passive trader and you're looking at your stocks once a month, maybe you don't need a great mobile app. Maybe your goal is to reduce the fees to the bare minimum, right? If you have the reduced fees to the bare minimum, you're probably going to have an okay experience. And if you're fine with that, that's okay. But if you need some kind of fancy UI or fancy experience, maybe you want to pay more for that. I remember someone asking in an email that Greg received about what about robo-advisors, right? For those of you who aren't aware, robo-advisors are basically firms that trade for you. Like you give them some money and they'll trade for you. Obviously, they're sort of like your investment advisor, and they automate everything. Obviously, if they automate everything, you don't do any work. You have to pay more fees, right? So usually they're around like 0.25% of your assets in fees. So I'm not a big fan of them because I don't like paying fees. I like to keep my fees minimum, razor thin. So, but if you're okay with it, robo-advisors aren't a bad tool. In my opinion, if you are willing to do your research and you're willing to learn through this webinar, you can definitely do as much as a robo-advisor, if not better, because they're not doing anything special over there. You can look up and read up on their investment analysis and their tools and their average return rate. It's not that crazy, right? They're taking a really simple methodology when it comes to it. All right, but once you open up a brokerage account at one of these companies or any of the companies we mentioned in the chat, I think you're ready to start thinking about what to invest in, right? Thinking about how to research and purchase investments based on their allocation and diversification. So I won't go over the actual process of purchasing a stock because it's pretty straightforward, right? You have to find the button that says buy. You click on that button and then you put in a stock and you can go from there, right? The UI and the user experience isn't too complex, so it should be straightforward. The hard part is knowing what to buy, right? So there are a few approaches to this, and usually when people get to this part, they're stuck. They're like, people always say, hey, think about the company that you use every day and start with that company, right? If you use a Mac every day, maybe look at Apple, right? But there are more, I think, better approaches before you start thinking about only the companies you use every day, because you want to think about risk, right? The first thing you want to ask yourself is, what is your appetite for risk, right? How much are you willing to lose, right? That's the real question when it comes to risk, right? And investing is not guaranteed. You never know what will happen. You could lose all of your money tomorrow, right? Even the most experienced investors lose money. The difference between an experienced investor and a beginner investor is that experienced investors are comfortable with losing that amount. Right? If they're not comfortable losing that amount, they've not gauged their appetite for risk. Right? And there's multiple ways of doing this, but I've linked 2 questionnaires below. You don't have to have an account with these firms to do the questionnaire. You can just check it out. So Vanguard and Schwab, in my opinion, have a really good questionnaire to determine your appetite for risk. Right? So many factors do are at play here. Your personality. Are you a risk taker? You're not a risk taker. Your investing goal, right? What are you investing for? Your age, right? How much time do you have to rebuild your wealth, right? If you lose it, right? And time, right? And etc. There's a lot of factors in play here, but it's something to think about when it comes to how you want to approach investing. And then too much risk can lead to losing a lot of money, right? Because, as I mentioned, right, high risk, high return, but also high risk means you can lose money. And too little risk means low returns, right? You're not making enough money. So striking a balance is really the key here. You want to get just enough that you're okay losing that amount, but you're still making enough money that you're satisfied with the outcome in the long run. Now, this is something I pulled from Schwab's appetite for risk survey or questionnaire, essentially. Right? You can see here they break down everything for you in terms of like which category you might fall under, and they'll basically tell you: are you moderate? Are you moderately aggressive, or conservative? Right? All of these things. You might fall under one of these categories. And you can see here right away, if you're conservative, your average return is going to be much lower than if you were aggressive. A conservative means you're taking less risk. Aggressive means you're taking more risk. And the trade-off is that aggressive performs much better, but their worst year is so much worse than the conservative allocation here. If you look at these two numbers here, conservative they will lose 4.6% in their worst year, but aggressive, they can lose up to 36% of their investments. So really striking that balance is key. Most of us will fall under these three categories here. Generally speaking, you're not in conservative territory unless maybe you're retired already, right? You can't afford to lose all of that money. And then they'll tell you basically how you should distribute your assets, right? What you should invest in. There's large cap stocks, which are basically mature companies that have a market capitalization of $10 billion or more. And in other words, there's a really big companies that are really shown to perform over time, right? So they're less risky, right? Because you know that they have a lot of resources to basically fight a market downturn, and they have a lot of resources to grow over time. Right, so good examples of this will be Apple, Alphabet, Bank of America, Johnson & Johnson, Exxon, and etc. On the other hand, with large cap equity, there's also small cap equity. These are smaller companies, usually ranging between 300 million to 2 billion in market cap. And for these companies, they're a little bit more risky, but there's also the potential that they'll grow much quicker than a larger company because they'll have more, the returns will look much better because there's more room to grow in a sense. But they are more volatile, right? Volatile, so something to consider. And international equity, pretty straightforward. That just means international stocks, right? If you purchase a stock for companies that operate in overseas, right? That's considered international. Fixed income, they're your bonds, they're your certificate deposits, they're your safe investments, essentially. And the safest investment of all is cash. If your money's not invested, there's no risk for it except inflation will eat it away. So that's something to think about. Generally speaking, if you're more conservative, you will have more cash because it's not going to fluctuate as much. Now, we talked about risk appetite. On a high level, really what that is diversification, right? As promised, I'm going to go over a little bit more here. And diversification, really, there's a lot of categories for it. The one we talked about just recently was levels of risk. Hey, someone asked a question. Please explain fixed income versus equity. Yeah, I mean, when they refer to fixed income here, it's really bonds, right? That's what they're referring to. And bonds are essentially you're lending money out to an entity, right? This can be a government, this can be a company. But basically, you're lending money out to them. They're going to pay you that money back over a period of time plus interest. So, it's basically a loan, and loans are generally safer depending on where you lend out your money. If you lend out your money to the US government, chances are they're going to pay it back over time. They haven't defaulted on a loan. So generally speaking, it's a much safer investment because it's almost a guaranteed form of payment depending on where you go. But when it comes to equities, which are stocks, you have no idea if they're going to do well or not. And there's no like fixed payment over time. Maybe there's dividends, but that's not guaranteed. Remember, it's just if they feel like it, essentially, right? They'll give it to you. If they don't feel like it, they're not going to give it to you. But fixed equity, you're going to be, fixed income, you're going to be getting a fixed amount over time, which is just them paying back your loan over a period of time. Yes, tips would be conservative. Yes. So if you buy treasuries, anything from the Treasury Department, at least U.S. Treasuries, right? From the bonds from the U.S. Treasury Department, it's safer. If you go to another country, not always the case. Something to keep in mind, right? So fixed income, there's some levels of risk associated inside of which asset you choose to go with. I mean, like I said, a lot of things to learn, a lot of topics. There's a lot of things in each of these topics to go over. But back to diversification. So level of risk, what we just talked about, something that most people start out with. You want to figure out where you fall when it comes to that. And other ways you can diversify is industry, right? People love to invest in tech. Everyone loves to invest in tech, no matter what age you are. You love to invest in tech, and tech is great because it's been shown to grow really fast over a short period of time. But it can't grow really fast forever, right? And it's not the only option. And as we've seen, sometimes the tech market will take a hit. The tech stock market will take a hit, and that will not bode well for your investments. But if you diversify to another industry, like maybe pharmaceuticals or grocery stores, for example, what happened here, right? For the pandemic, grocery stores, department stores, well, not department stores, grocery stores and companies like Walmart really shot up, right? Because people needed resources and they were a great place to go. So you really want to diversify industries, because if an industry crashes because of a policy from the government, for example, you don't want all your assets to collapse. You only want a portion of it to collapse at the very least, and you want other assets to go up in value. And diversifying your industry is one way of doing that. Some people do mention that you can have country diversification, and country dependent diversification is really difficult because most companies are globalized to a certain extent, especially if they're much larger, and it's going to be difficult. So this one, I think, is, people mention it from time to time, but I don't think it plays that large of a stake anymore nowadays. But there are differences and nuances depending on what kind of company you choose to invest in. Here's a question. I know tech better than pharmaceuticals. How can I get familiar with that industry? Well, just to be clear, just because I said pharmaceuticals doesn't mean I'm recommending, hey, go invest in pharmaceuticals. I'm just giving an example of a different industry, right? If you come across an industry that you're not too familiar with, whatever that industry may be, right? For example, what if it's biotech, right? So maybe it'll fall underneath the umbrella of pharmaceuticals. Well, it depends, right? How are you looking at this company, right? We talked about the different approaches we've taken, right? You can do a fundamental analysis. Take a look at their competitors. Take a look at what kind of drugs they're researching, right? How large is that market that they're trying to address, right? You don't need to know how they're making the drug or what their patent looks like, right? It'd be great if you did, but you don't need to know that. You just need to know how much potential does this company have to grow, and if you think it's good, and if it makes sense to you to invest in them in the long term, or maybe in the short term, depending on what your strategy is, right? Then you should go ahead and feel confident with that once you've done your due diligence and enough research into that industry. But generally speaking, it's like any research project. Once you start looking into it more, you'll start getting an idea about terms, what the market looks like. Does this market have a large addressable market, right? Or is it just contained to specific key players? How competitive is it? These are things you can think about and start doing research on if you don't know the industry very well. And the last thing here for diversification is to use a mutual fund. This is what I do. This is the easy and lazy way of diversifying, right? Basically, you're saying, hey, I'm not doing any diversification. I don't want to pick my stocks. I'll let an investment, someone, a professional investor, pick those stocks, and I'll just let them charge me a low fee, right? Or a high fee, depending on what kind of mutual fund you pick. But they'll handle most of the heavy lifting when it comes to diversifying, and they'll tell you how they're diversifying on like a very high level, right? They're not going to tell you what's in the funds, but you get an idea about what you're diversifying in. Now, once you've done your research, you've opened a brokerage, you've purchased all your holdings, you've matched the risk appetite by percentage down to the exact number. And now we have to think about, over a period of time, your investments are going to go up. Some investments will go up, some investments will go down. If you diversify well, that's what's going to happen. If you didn't, then they're either all going up or they're all going down, right? Unless the stock market overall is performing really well. But generally speaking, some will go up and some will go down, right? Since your investments will change in price, that also means the allocation of all your holdings will change over time, and that you need to rebalance your portfolio, right? So you need to fit the risk appetite or whatever your target allocation is over the long term, right? So if after you purchase everything, your goal is to have 45% in large cap, 15% in small cap, 20% international, and 15% fixed income, and cash 5%. Let's say if in 5 months, your large cap stocks increased to be 60% of your portfolio, right? And a small cap decreased to 10%, and international decreased to 10%. So what you have to do here is you have to basically sell your large cap and buy more small cap and international. The goal being that you get back to that 45%, 15%, and 20%, right? Because if you have too much in large cap, then you're not being risky enough per se, right? You're not doing enough in small cap international, right? Whatever investment strategy you stick with, you should stay with that strategy unless you intentionally decide you want to change it, right? And it's the difference between intentional and not being intentional is if you're too lazy to sell it, that's not being intentional. If you're doing active research to change your strategy and have a different target allocation, then that's being intentional, right? And that's fine. You just need to understand that if you have a strategy, stick to it. Or if you decide to change your strategy, understand that you're changing it for XYZ reason. And the allocation is going to look different going forward, which is fine. All that matters is as long as you're intentional about it. Now, the last thing I want to talk about here is paying your taxes, right? Taxes are always a little bit tricky when it comes to investments, and they can be very tricky depending on when you decide to sell, how much you sell, and how you tell the brokerage to categorize your investments when you sell them, right? There's different methods to calculating that. And I prefer to go with an accountant, but up to you if you think that you can really handle all of the calculations. And it will really depend on how many investments you have and how much you decide to sell at that moment. So taxes, again, like I mentioned before, are paid on realized gains, right? So if you have a stock that increased in value, but you didn't sell it, you're not going to be taxed on that, right? So rebalancing can trigger a tax event because to rebalance, you're likely going to sell and buy more, unless you're putting more money in, right? That's going to be different. But if you're rebalancing by selling and buying, you can trigger a tax event for that year. So something to be aware of. And realized losses can reduce taxes, right? So, and the specific rules for how they can reduce taxes, how much you can reduce each year, and if it carries over to the next year, I'm going to leave out of this because it can get complicated. What I want you to do is do your research when it comes to these, right? And lastly, when you do sell your stock or when you do get dividends, the brokerage firms will send out forms, right? IRS forms for you, likely at the beginning of the following year. So you have time to file for taxes. So this is your 1099 div for dividends, your 1099B for any realized gains. Or whenever you sold stock, you get that. But high level, it's a form, right? All you gotta do is fill it out. If you're really trying to maximize your taxes and maximize or really reduce your taxes, not maximize your taxes, reduce your taxes. It may be worth speaking to an accountant about that. But here are some additional resources aside from all the links I provided that might be helpful for you. So the way I got started with really serious stock investing was through J.L. Collins. It's a blog series. about stocks basically. It's like, I don't know, 30 blog posts where he goes over basically all the ways that you can invest in stocks, type of stocks, and his approaches to it. So I really encourage you to read that. It's generally geared toward passive investing. So if that's not your tool, maybe like someone mentioned, Seeking Alpha, another great place to look at for articles, especially if you're an active investor. If you're looking for specific companies in general, Seeking Alpha is a great tool. But they're also linked to tax efficient investing. And if you really want to dig into taxes, it's right here, Investopedia. If you're more of a video person, there's always the Plain Bagel YouTube channel. It's a great place to learn about investing with graphics and videos and whatnot. So that's linked there as well. And yeah, wrapping this up, I do have free 30-minute sessions if you want to talk to me about your financial situation. Like, this doesn't have to be stock market investing. And you shouldn't make it about stock market investing, because I won't answer those questions because, legally I'm not allowed to tell you what stocks to invest in. So, it's not gonna lead you anywhere. But otherwise, if you have other situations you want to talk about, I'm free to chat. Just because I have so much time on my hands with this pandemic now, but it is, I do have the time available. You can click on this link, and I will share this link as well in the chat. But if you click on it, you'll end up on a Calendly link where you can select time. I can do a phone call, I can do Zoom, really whatever works for you. But aside from that, I can take questions now, right? I've linked my blog where you can subscribe for new blog posts, right? If you're interested in that, you can email me if you prefer. And my next workshop is about renting versus purchasing a home.
Yeah, thank you so much, Alan. And yeah, a quick note to everyone who tuned in. We're going to have 2 more webinars with Alan later in the semester. The next one is going to be about renting versus purchasing a home, and that's going to be on November 18th, also from 6 to 7. I will send some details in the follow-up email about how you can RSVP for that. We'll also send the video recording of this out as well, just as a reminder. As well as the slides, so you'll be able to go to all the different links that Alan was using. And I do see a few other questions. We're going to stick around a little bit to answer some more questions. Also, feel free to suggest other topics you'd like to see us cover. We're looking to create more programs to touch on the content you guys are looking for. So let us know in the chat or send us an email. Happy to chat more about it. Alan, any other questions?
Yeah, definitely agree with Greg on there. I'm just going to go ahead and address more of these questions, unless you have something more to add, Greg.
No, go for it, Alan.
Great. So someone asked, the breakdown percentages that you shared, is that considered aggressive or moderately aggressive? Let's take a look. We go all the way back here, 45, 15, 20, 15, and 5. You'll see here that it's moderately aggressive. So hopefully that answers your question. For those of you who are curious, I am on the extreme form of aggressive. I basically invest only in stocks and I have nothing else. But that's just due to my investment strategy. But I wouldn't encourage that for people who are just starting out unless you have a plan in mind. Will you be conducting a more intermediate webinar in the future? I think it depends on what specific topic you're interested in. If for anyone who's interested in passive investing, right? I'm really big on passive investing, right? I've done enough research, enough historical data, and enough like just digging into this area that I can talk a lot about passive investing. But for active investing, not so much, right? I'm gonna claim that I don't know much about alphas, betas. I don't know much about like all these other tools that people are using for really technical analysis when it comes to specific stocks, right? So I don't know much about that, but if you are interested in passive investing, which is what I mainly exercise myself and mainly what I'm an expert in, I can talk about that. But otherwise, I don't see myself doing any active investing webinars. calls or put options would be nice. Oh man, those are like really, you can make those really into gambling, depending on how you use those. um, but I'll take a look. I'll take a look into calls and puts, and I'll get back to you if it's something that I'm open to doing. Retirement funds. Yeah, I've done investing for retirement workshop before, so I can talk about that. It's also heavily how I'm investing for passive investing when it comes to retirement funds. I believe someone mentioned something about possible topics. Best strategy to pay off student loans. Yeah, I gotta take notes here. I don't think these chat records are recorded anywhere.
No, we get these recorded. Yeah, the chats, we'll have
The
these.
chat is
So
recorded.
I love all of these different suggestions so far. I do want to also note that we did our 3 financial literacy workshops in the summer, which we do have recordings of. And so I'll share those in our follow-up email as well, because Alan talked about retirement as well as helping your parents retire, which was another popular one. So we'll share links to that as well.
Yeah, definitely. Someone asked, what are good resources to use to research potential investments? I think Seeking Alpha. I personally, when I was an active investor at one point in my life, where I lost money, for those of you who are curious, I was using Seeking Alpha as a tool. Yahoo Finance is a great tool as well. And any of these brokerages will have tools for you to research stocks, right? So that's another way you can look into it. But most of the time, it's a quick Google search away, or you can go on any of the tools that I mentioned. When you refer to passive investments, can you make a few that you're involved in? All right, so this is where I plug my disclaimer really hard. I invest in these personally. I'm not saying you should invest in these. Something to keep in mind. So I invest in something that's called total market index funds. You can Google that. But a quick example is VT SAX, spelled VTSAX, is something that I invest in, which is just investing in the entire US stock market. So, the stock market swings up, I do great. If the stock market does poorly, I'm not doing so hot. You can basically tell how my portfolio is doing if you just look up the stock market every day. What's the difference between large cap and small cap equity? The biggest difference is the size of the companies. Right, small cap is more risky because the companies are smaller, so that means they just don't have enough resources to necessarily survive something like a recession. Right, a large cap are companies that are proven to grow over time and to sort of sustain themselves over a longer period of time. Ooh.
Oopsies. Okay, I muted that. I also wanted to share the link to the Helping Your Parents Retire webinar, which I've just pulled up. So I've shared that in the chat. So if you missed that one over the summer, feel free to click on that link. It should direct you to the appropriate recording. And I'll share those also in our follow-up email to make sure everyone's got it. Thank you to Jennifer, who said she attended and enjoyed it.
It's good to hear. Someone asked if I'm going to do anything about derivatives. I am not going to do anything about derivatives. I can say that absolutely positive that I'm probably not going to touch derivatives. It's not something that I have expertise in, so I would not want to lead anyone down the wrong path there. What about VTBLX? Yeah, I mean that's great too. I think most of the Vanguard funds, right? If you do research, most of them are good, in my opinion. They've never done me wrong yet, so I personally would invest in them. But if they fit into your portfolio, something that you should do some research on if they fit in that regard. But a lot of these mutual funds will have yearly, quarterly statements that you can look at to see how well they're doing and how well they perform over time. Right, so that's what you see a lot. But as they say, past performance is no indicator of future performance. Right? So if a company is doing well for the past 20 years, there's no guarantee they'll do well the next year. It's likely, but there's no guarantee. But yeah, hopefully I answered everyone's questions. But feel free to reach out.
Yeah, thank you so much to all of our alumni who joined us, and for all of your questions and for being such an engaged audience. We have a few events coming up later this month that are also career-oriented. They're hosted by the Star Career Development Center in collaboration with Alumni Relations. I'm going to actually share the link to our calendar. so that you guys can check out future upcoming events in addition to the ones I discussed with that Alan will be hosting. Really appreciate you guys being here this evening. This was super interesting, and I hope that everyone learned something and is going to take something out of this. If you guys are interested in getting involved in stocks. And we will definitely consider all of these other great suggestions as well for future webinars. I want to thank you, Alan. Thank you for taking the time out of your day to do this, as well as your willingness to chat with alumni, even just you know, on your own time if they sign up through your website to chat. We really appreciate that, and you know, feel free to take Alan up on that. That sounds like a really great opportunity just to, you know, share some ideas with him, get Alan's take on things. And continue to check his blog out as well. He writes about some really interesting topics. So thank you very much, everyone, for joining us. And I look forward to seeing you guys at a future event soon. Alan, would you like to have any closing words?
Yeah, I would say definitely share the chat logs with me, Greg. A lot of great ideas there. So I'm definitely going to take a look into them. And some of them I've done to a certain degree already. So, you know, happy that everyone came to watch the webinar. I'm always happy to share knowledge just because I know that, you know, being from CUNY, it's very tough to get all the financial knowledge you need to really build wealth, right? So I'm happy that I can help out there. And, you know, the goal is not to sell you anything, right? The goal is to make sure that you are financially educated and you have enough tools to learn yourself. In closing remarks, I'm going to ask one last question, and I'm just going to answer it. Book recommendations for financial literacy. You know, this is always a tough one for me, but I would say The Simple Path to Wealth, which is also a book written by J.O. Collins, is something that you can take a look at. Oh man, the questions just keep coming. As a starter investor, what are the best applications to use? Use the brokerages. They're great applications in terms of that. Yahoo Finance, Seeking Alpha, you'll find great tools there. But yeah, you know, if you have other questions and I don't get a chance to answer them, shoot me an email. You can sign up for one of these financial literacy coaching sessions, or, you know, ask a question to me anonymously on my site. I am available. And yeah, good luck. Stay safe out there during this pandemic, and I hope to see you in another webinar.
And as a reminder, we'll share the slides as well, where Alan had a lot of different resources that you could also check out. So if we didn't get to any resources specifically in the chat, you will be able to check out what he referred to in his presentation. Thanks again, everyone, and hope to see you guys again soon. Thank you, Alan. Have a great night, everyone. Take care.
Take care.